Hello everybody and welcome to our next video on auditing. In this video we're going to be covering managerial assertions. This is an important topic if you're taking the auditing course or looking for the CPA exam review. This is another one of those items where you just have a list that you just kind of need to memorize some terms and you need to be able to match them up with the corresponding explanation of that term. So we're going to go through a few different levels of this. You'll see a lot of repetition for some of them. But the idea here, first of all, is that a managerial assertion is basically something management is telling you about the information they're reporting to you, and you as an auditor need to test that. They're asserting something. They're telling you some piece of information, and you need to know, how do I verify whether that's true or not? To make sense out of this, you really need to understand the risks behind certain assertions, and furthermore, how you would test each of them. Now, I'd say the most important piece of this is what we're going to call the general assertions. This, when I was studying for the CPA exam review, this was the main thing that was covered. And what I found was that when I understood the general assertions, the other assertions, there's a lot of duplication between them, and they tend to come to you a little more naturally. So there's a lot of terminology here. If you're concerned about memorizing all of that, or if you're concerned about the time, I would say focus first on the general assertions. Get those hammered down. There's only a few of them, only 5 of them. So if you get those hammered down, you're going to do a lot better with the other portions as well. So we'll cover that and we'll talk about it. So we have the general assertions. We have assertions about certain classes of transactions and events. We have assertions about account balances, and then assertions about presentation and disclosure. Again, by understanding what type of assertion management is making, then we can better understand how to test it to make sure it's correct. Different accounts, by the way, are going to have different assertions. It's all about risk. What do we think that management, if we're talking about an unethical management, if there was unethical management there, what do we think they would be lying about? So what would they tell us that we should be concerned about testing? So the general assertions, I said there were 5 of them, and they're pretty straightforward. You're going to see a lot of duplication, a lot of carryover between these and those other classifications of assertions. And this is the only one I was able to really come up with a mnemonic, and I can't take credit for that myself. This is the one I learned way back in my first auditing course. Although when I took the CPA exam review, they did go through some of the others a little bit. They had some other mnemonics. I'm not going to copy all of that, obviously, but these are the ones I first learned. So PERCV. Now, for some reason, the way that stuck into my head was Percy, except there's a V at the end. So if that works for you, or just maybe perceive. PERCV kind of looks like perceive. Are you perceiving these general assertions? So again, whatever works for you. Presentation and classification, they kind of go together, but presentation is the word in the mnemonic. Existence. We're going to see what all of these mean in just a bit. Rights and obligations. Completeness. Valuation and accuracy ties along with that. So again, a couple of mnemonics. Perceive is maybe the nicest. It's an actual word, except you're missing a few letters. So whatever works best for you there. But let's talk about these and see what each one means. Presentation and classification. Did the company properly present that information that happened throughout the year? Did they put it in their statements and footnotes? Is it easy for a user to see that and understand what they're trying to communicate? Did they properly classify things that were current or long-term, assets or liabilities, for example? Did they properly classify income and expenses as either operating or non-operating? So management is making an assertion that, hey, we did present everything properly. The risk is that they haven't. Then again, it's all about professional skepticism. When you're in an audit environment and you're auditing a client, there's something called professional skepticism, which basically means you're not assuming they're lying about every single thing, but you want to verify it. You're not outwardly calling them bad, unethical people, but you always have to assume that that risk exists, that they may be trying to lie to you or spin it a little bit differently to persuade you to give them a good opinion. You always have to assume that, so you want to figure out what would they most likely be lying about or not telling the full story about. So if they say they presented it properly, we have to verify that they did. We have to look from the perspective that perhaps they didn't. So we're looking for proper classification here. The way to test for this is to review it, see if anything doesn't make sense. Is there anything you found to be a current asset that really is reported as long-term, which is opposite of what they'd usually do? Sometimes you just ask questions about what you found. We get into all the detailed testing in later videos as well. Existence is actually a very important one, and this usually comes up with assets or revenues. In other words, the good things that help a company out. Because the concern here is that if management is asserting that this exists, this asset exists, this revenue exists, of course they'd want to assert that because they reported it and it helps out their balance sheet and income statement. Our concern is maybe it doesn't exist. Maybe this asset that you're reporting on this financial statement is completely made up. Maybe it just flat out doesn't exist. This piece of equipment, it could be a phony number. So we're trying to make sure it exists. Our risk usually is that they're overstating good things. It's always an overstatement concern. Anytime you're looking at existence, it's an overstatement concern. We're concerned that they reported something that shouldn't be there, that doesn't even exist. So to test for this one, you vouch down to supporting documentation. In other words, you take the number from this high-level perspective, the financial statement, and you start working down into the details. You vouch down. That's the term you use. You vouch down to the details, and you inspect the underlying assets themselves, possibly the documentation for the assets. If it's a sale or a revenue, you look at all the invoice documentation just to make sure it really did exist. Rights and obligations. This ties with the existence assertion. So you may find that an asset existed. It's in this room. We saw it. We know it's there. But do they have the right to that asset? Do they really own it? They may be holding it for somebody, and maybe it's not theirs. Physically it's there, but it's not their asset to report. So it's the same thing. We're trying to make sure they didn't report something that really should not be reported. A few examples of this would be accounts receivables that they have no rights to, a sale that wasn't even theirs to report. If they're consigning items for another company, they may physically have the inventory on hand, and they may have made a sale, but it's not really their sale. It's the original store's sale. They get a commission, but that's it. An asset that they're borrowing, they can't report that as theirs. So after you verify that something exists, inspect the ownership documents of that asset to make sure they purchased it and it really is theirs. Completeness. This is almost the opposite of existence, and I would actually say it's the opposite. Now we're concerned with, did they report everything? Generally, this would be bad things we're looking for. And when I say bad things, I'm talking expenses, liabilities, things a company doesn't want. But of course, if they exist, they have to report them. So the one thing I do want to mention here, we're not just talking about the value of a particular transaction, because value is a separate assertion altogether. We're just talking about, did they report the entire thing? If there's an expense out there, did they completely forget to report it? If there's a debt out there that they owe, did they forget to report that, intentionally or unintentionally? This is actually one of the most difficult tests, because we're trying to find proof that something may have existed at some point, even though there's nothing really leading us to that. With existence, there's a number they started with, and we can just say, prove this number. Prove that this thing you're reporting exists. With completeness, we're trying to find something that's missing. We're not even sure if it exists. So my little statement here is we're looking for a needle in a haystack without any proof this needle actually exists. So you have to call into question, how long do you spend searching for something that you're not even sure if you can find? You don't even know if it exists. So that's why it's one of the most difficult assertions. Valuation and accuracy, this ties everything together. So if they've reported something, we found it existed, that's fine. But was it valued properly? Did they put the right amount down for it? Same with the completeness. Did they value it properly? The risk here is that they're going to overvalue the good things and undervalue the bad things. Again, that's the risk you have to come from. And the idea here is once we know there's an item that exists, we just verify the value from that supporting documentation. Now the good news is once we get through those general assertions, you're going to see a lot of duplication here. There are some slightly different terms, but these are assertions about particular classes of transactions and events. So here I don't really have a great mnemonic for these other ones. Again, the way I studied it first, I focused on those general assertions, and I just read through these other assertions, but you're going to find so much coverage, so much overlapping of them, that generally when you see the term, you kind of have an idea what it is. As long as you know the general assertions, these other ones will make a lot more sense. Sometimes it's a complete duplicate, other times it's just a similar term. Occurrence, completeness, accuracy, classification, and cutoff. So really the only new ones are the occurrence and the cutoff. But even occurrence we're going to see is very similar to existence. But cutoff is something a little bit different. Occurrence, again, did this particular transaction actually occur? So now we're not so much talking about a balance or an asset. We're talking about a transaction or event. That's why occurrence makes more sense than existence, but it's the same basic thing. Our risk is that a good thing they're reporting really didn't occur at all, and it shouldn't be reported. The test is simply to verify the supporting documentation for that transaction that they're listing. Completeness, it's really the same thing as before. Did they report everything? But we're talking about an actual transaction now, so is there something that happened that they flat out didn't report? But all the rest of this verbiage is the same as the last time. Accuracy, so again, we're dealing with transactions now, but was the reported amount for that transaction proper? Classification, same basic things. Now cutoff. This is a little bit different because it's about timing now. It's not so much about existence or even valuation. It's about when was it reported. They could prove that, hey, this transaction occurred, it existed, and we valued it properly, but we put it in the wrong year. That's what cutoff gets at. This is important under the accrual basis of accounting because the cash itself may not have changed hands in the same year as that we need to report it under. So there are a few risks, but even with these risks, you want to make sure it's in the proper period. Whether that helps the company or hurts the company doesn't matter. You want to make sure it's in the proper period. So the general risk is that a company may try to accelerate revenue recognition, put it in an earlier period, capture it early to help them out now instead of later. But that doesn't mean there might be situations where a company wants to delay revenue for a little bit. If they've already got a great year going on this year, maybe they don't want any more revenue because it's just going to raise their standards for the future years. The company may try to defer expense recognition to a later year to help out this year. But again, that does not mean there might be situations where the company wants the expense now instead of later. You just have to take a look at from this risk perspective first, but then if there are any other red flags that come in to play, be aware of those as well. The tests are similar to the idea of accuracy. We're looking at the underlying documentation, but now we're looking for timing. When did something actually get earned? When did an expense actually get incurred? That's what we're looking for. Now we move on to assertions about an account balance. So a lot of these are the same. We have existence, completeness, valuation and allocation, and rights and obligations. Existence is the same one, but now we're focusing on a specific account balance. Completeness, same basic thing there. Valuation and allocation, and rights and obligations. So we move on to the last section of assertions about presentation and disclosure. A lot of duplications, as I've repeated multiple times. Occurrence comes up again. Rights and obligations, completeness, accuracy and valuation. We have a slightly new one here. It's a little bit different than the last time. It's overall classification and understandability. But notice, these 5 assertions are about how management has presented and disclosed information on the financial statements, or really in the footnotes is what I would get at here. So occurrence. These might be things that they have not actually reported on the financial statement, the face of the financial statement, but maybe there are situations that the provider, when I say provider, I'm talking the company, the client has disclosed. So if they've included it as a footnote, did it actually occur? Rights and obligations, again, now we're focused on the footnotes again. Completeness, so this is an important one for the disclosures because we want to make sure the company has included any required disclosure that the user would need to be able to make a good decision about the company. So there are a lot of requirements under GAAP for what needs to be disclosed. If they found any errors in prior years, those need to be disclosed. If there were sometimes changes in fair value of the assets, some of those need to be disclosed. Any change in methodology needs to be disclosed. So completeness is perhaps one of the most important ones for presentation and disclosure. Accuracy and valuation. So this is generally when the company has reported an amount in summary on the financial statement face, and then they're providing more detail in the footnotes. So this accuracy and valuation, it also has allocation into it as well. Did they allocate the value of the fixed assets to all the detailed ones that are listing in the footnotes? It's just one example. And the final one here is classification and understandability. It's a big picture assertion for the presentation and disclosure side of things, because what we're basically asking is whether or not overall is the financial statement set understandable to a user. Did they put all the footnotes necessary for an informed user to make decisions about the company? Is everything clear? The whole idea of full disclosure. Is everything there that's needed to make a decision about the company? Everything that's needed to understand the full financial statements? So that's what we're getting at with this last one. So hopefully this video is helping you to understand some of these terms, what they mean. Again, this is one of those things in auditing where it's a little bit of memorization, and you're certainly going to see it on your earlier auditing exams. If you're taking the CPA exam, this definitely comes into play there. So I hope this has helped, but I look forward to talking to you in our next sessions, and thank you for your time.